All right, an awesome day in the VIX for the short vol people, and some people questioning why they didn't make more to the downside here. Let's talk about that in just a minute coming up. Stay tuned. All right, and welcome back to the Short Vol Show. My name is David, and this show is sponsored by Gorilla Trades. Check out Gorilla Trades for some great ideas at what to buy. I'm not a stock picker, I'm an options trader, but Gorilla Trades is able to pick out some winners all the time, and check them out at gorillatrades.com or check out the link in the description. So, on to the VIX, rally in the markets today. Let's take a look at just the E-minis for a second. This is what it looks like over the last week, and you can see that big down move on the 10th, and just kind of going a little sideways since then, trying to recover from that huge down move. And even though we are, not even a third back from up that chart from that down move, we still have made progress, and vol is coming in accordingly. The VIX down 276, almost 3 points today. And you might think, okay, VIX down 3 points, that means UVXY probably UVXY is probably going to be down $6, right? Because, or I'm sorry, 1.5 times whatever that move was. So $9 UVXY should be down, right? I'm sorry. Let's start over again. My math is messed up today. VIX down 3, UVXY should be down $4.5, right? Because 1.5 times leverage. And UVXY is not down $4.5. It's only down 383. Why is that? Well, that is due to the fact that the term structure needs to normalize now. Now, you saved money on the upside with the VIX spiking to the upside. UVXY did not go up nearly as much as the VIX did, and thus on the downside, you're going to pay for that a little bit in that UVXY won't go down as much as the VIX because the term structure now normalizing. What do I mean by that? Well, let's take a look at the term structure for a second, and we can sort of graphically look at this a little bit better. Okay, so here's the term structure right now, and you can see that spot and M1 are converging. The first month, October, you can see it's right on spot, and that would make sense as expiration is right upon us. However, the months after that are still in the smiley face position, and that being in backwardation for the first 2 months and then into contango. And what happens is that if you looked at the chart 2 days ago, you would see that we were close. But if you looked at it 2 days ago, you would also see that spot was way higher points above any of the futures. And right now, it's just kind of coming back in line. What we need is a continued down move for the term structure to get back into contango. And you will see these futures lag the move in the VIX to the downside until we get back into a contango situation. And that's just the way this trades. I got a chance to talk to Stuart Barton from Invest in Vol the other day, and we were discussing what makes the VIX trade a unique trade. And one of the main things that makes the VIX trade a unique trade is that there is no arbitrage opportunity between the futures and spot. If you have the S&P, for example, or let's take the NASDAQ futures, it all kind of makes sense in the end. Spot can be, if spot is, if the futures are, there's an natural arbitrage in the NASDAQ between the futures and a basket of NASDAQ stocks that that keeps these things in line. With the VIX, you have these futures, and they're kind of bouncing all around, and there's no natural arbitrage, and so stuff moves around, and it's just the way it is. These, futures can sort of have a mind of their own in a way, and as we spike, futures tend to lag behind spot, and as we come back into line, you'll notice that the curve tends to try to get back into sort of a contango shape as quickly as possible. It can be interesting to watch the farther out futures and what they're doing. The farther out futures a week ago were like in the 16s. Now they're up around 18. The longer we stay elevated, the more the farther out futures will be affected. But even though, some of these might have lagged a little bit behind what you might have expected in the down move here, this is still a great, great day for the VIX, as we've shaved almost 3 points off of it. I guess it's a great day if you're short, I should say. So a little over 2.5 points down in the VIX right now. And, there's a lot of damage done on that day, the 10th, to the term structure. And term structure can be pretty robust and pretty resistant, as you noticed over the last couple months. But a big move like that, and there is damage done, and it takes a while for that to correct itself. Now, the VIX either staying in place or going higher, either staying in place or going lower is going to, the term structure is slowly going to line up over time, and you can watch it line up. It's going to line up back into that contango shape that we like so much. So be patient here, folks. Like I said, if you look at this chart here, we're all based on the actual underlying indices, and so the more progress we can make to head back toward the highs, the better off we're going to be in the VIX here. But also think about it in terms of realized volatility, and by that I mean how much is the SPX moving around every day. If it's these days where it went sideways like that, well, after a while, the average, if you take the average move over, the 10th and the 11th, it's going to be huge. But if you add the average, if you add the 12th to that, the 13th, 14th to that, not the weekend obviously, but if you add the other trading days to that, slowly the average realized volatility, or the average that these indices are moving around, is going to become less and less, and that's going to justify the VIX coming in. So the more time that we either move up slowly or sideways, the more there's going to be pressure on the VIX to go lower. And great move today. Any day we would love to see down 2.5 points in the VIX. But the 2.5 points between 20 and 1850 are basically bringing spot back towards the futures. The next 2.5 points from 18.5 to 16 would bring the structure back into contango, and would start the decay of VXX and UVXY. Remember, now we're still in backwardation, so every day there is actual decay to the upside. These UVXY and VXX are being pushed upward every day over the last couple sessions, and they're getting sucked upward through time. Even now, today, we still are in backwardation. Let's take a look at how far we're in backwardation right now, but we are still in backwardation. So these things still getting sucked to the upside as we come into expiration. However, the down move in the VIX has certainly been bigger than the pressure to the upside. So remember, backwardation or contango are long-term effects. The short-term down move in the VIX is a much bigger move than the small effect of backwardation right now. And that's why we tell people when we're in backwardation, don't focus too much on that 5.4% number when we're anticipating the spike to go back down. We want to make sure that we recognize that this contango or backwardation number is a long-term number, and in the short term, we're expecting the spike to succeed, and that's going to be the most important factor that we're thinking about with VIX products right now is just the spike ending and these going back down. So I did see people saying a great time to buy UVXY here, and maybe, but if these indices go back down, if this is just a blip and these head back to the downside, then it's a good time to buy UVXY. But there's also the chance that if the VIX just stays where it is or goes any lower, UVXY is going to continue to get killed. Remember, UVXY did come from down in the, it sounds like the 40s is the low, but nope, down around 35. That's where it was headed to. This chart behind me here, you can see kind of the down trend and then the huge spike here. But, I mean, we could see this as a continuation of the downtrend here. It will, at some point, continue lower. I don't know if today it continues lower from here or if we get another spike. I can't tell the future, and I'm not trying to tell the future. However, I know over time we will go lower. And for those of us who are short, which I am one of them, it's a nice day for us. So anyway, I know people get confused. The other frustrating thing for people who are short who bought puts is that as we're in a spike, they raise the volatility of the implied volatility on the options on UVXY. So, for example, UVXY implied volatility for November at the money right now. At the money strikes maybe the 50 strike. I'm showing 129%. Okay. When we spiked the last day or two, this percentage was a lot higher. When market makers know that when we come in, when we spike, people come in and buy puts. A lot of times they're people that aren't paying attention to the implied volatility in the options all the time, and they just instinctively say, okay, we got a spike, I'm going to buy some puts, and then I'll ride them down. So when we spike, market makers raise the prices of everything, puts and calls, way up because they know that it's going to be mostly buyers. And in fact, they will raise them until they get sellers on the other side. It's called price discovery. So they will raise the price of puts and because they're getting mostly buyers, and they'll sell puts on the spike. Then when we go back lower, they will lower the prices of everything because they know that the people who bought the puts on the spike will come back in to sell them out to make their profit. And so they will take everything down. The lower we go in UVXY, the lower the implied volatility will be in the options. And of course, there is a skew in UVXY as well that to the downside, where out of the money puts have a lower volatility than out of the money calls. And as we move down on the skew, implied volatility is less. So you're going to see puts come in as we move lower. However, if you buy a put spread, let's say you bought the UVXY November 33, 31 put spread. I'm sorry, November 50, 45 put spread. You know that put spread is worth $5 on expiration if we're below 45. And so you can evaluate, if you're actually buying a put spread where you're buying one option and selling another, you don't have to worry as much about volatility, and you can evaluate it just on the merits of what kind of move you need to break even and make money. So for example, the 50-40 spread, 45 put spread for 2 November right now, midpoint's around 294. So let's say $3. So if you're paying $3 for this put spread, that your break-even point is going to be 47 in UVXY in 17 days, and you know that your maximum profit will be below 45 or at 45. That doesn't change with the volatility coming in or out. So it can be a lot safer just to buy a put spread than buying expensive puts in these issues. Or if you're going to buy expensive puts, once you make that move lower, sell another expensive put against it. So for example, on the move with this around 50, 55, you might have gone in and bought a no 50 put. But then once we roll down a little lower, you could sell a 45 put against it maybe, or sell another expensive option against it. That way, offsetting the moves in implied volatility. Because just buying a really expensive put and riding it down to expiration can be a tough way to make money, because you're going to see the break-even point is pretty far away. For example, right now, if you were to buy the NOV 49 put and pay the offer, you pay $660 for that put. You know, break-even is almost like 42 in UVXY, and that's a tough break-even point with only 24 days to go. So much better to buy the 49 put and sell a 43 put against it, or sell a 45 put against it, or sell a 48 put against it, and give yourself more of a chance. You're limiting, of course, your ultimate profitability, but at the same time, you're giving yourself a much higher percentage chance of making money. So I pretty much stick to buying put spreads or selling call spreads in UVXY nowadays, as I consider selling naked calls too much risk for my comfort. I want to sleep at night. So anyways, great day for the short vol. And if you have this position on, hang in there, because I know this first move in the VIX is just trying to get the term structure back in line. If we continue this path, though, the real money will come to you. So thanks for watching, and I will see you in the next video.